Hello, I'm Jason Kim, the Clueless Investor, and let me just start with the elephant in the room. This video is disgustingly long. I made a mistake. I didn't realize that if I chose a topic that takes several hours to research, that I wouldn't be able to cut down that footage into a reasonable amount of time. And I should have broken this down into 4 different parts, but I didn't know, and now I know. So this video did not go the way I was planning originally. I did a whole thing on securities lending because it was relevant to what my dad was interested in at the time. I did the research, I wrote out a script, started filming, and then halfway through, I realized I hated it. It just felt not like me. I know in my intro video, I kind of took this position of being a sort of ironic teacher, given that I don't know much about the topic I was choosing to teach. But as I was executing the idea, it just didn't feel right. Frankly, I felt like I would just be misinforming any poor soul who came here to learn finance. And I would just be doing a worse job of what a lot of other perfectly fine YouTube channels are already doing. So my lesson there was I am no teacher. I am very much so a student. So I'm going to try something different. I'm going to try to focus more on the portrayal of learning. I have 2 reasons for this. The first one being that I feel that with the advancement of AI, many people right now are substituting learning with just having the answers. I mean, you hear stories all the time about people just getting through high school, college, even job interviews with AI, and not in a healthy, oh, I'm going to use AI to help me better understand such and such topic. It's more like, I'm using AI to write a slightly less than perfect essay for me to pass this class that I should have spent 40 hours studying for. And I know there's probably a decent chunk of people using these tools in ways that are actually constructive. But I really think a lot of people in the future are going to find themselves pretty much devoid of much useful knowledge and are always going to need to rely on some search engine or AI assistant to help them do a lot of things. And I'm not talking down on anyone doing things like that. I definitely would have been part of that group of people who would take advantage of AI to get a lot of my work done. I get why people would be using these tools this way. Learning can be incredibly frustrating, tedious, stressful, and boring if you're learning something you're not fully interested in. Why would anyone want to spend so much time trying to understand something when you can just have the answers in a few seconds and then go spend time with friends or watch TV or anything else exciting? Well, that's a good question. And while I don't have a general answer to that, my answer to that question for me is just having the answers to my questions doesn't make me feel like I know anything. If I have a question that I'm stressed about, that stress doesn't get relieved until I know the mechanisms and reasonings behind the answer. An answer is like a fruit. It's sweet, tasty, and quick to enjoy, but understanding is like the seed inside. If you plant it, nurture it, and learn how it grows, you can grow your own fruit. And I am not content spending the rest of my life having to pick fruit from someone else's tree whenever I want a treat. I want to know how to grow them myself, if that makes any sense. The second reason is that I want to show how someone gets from point A to point B in becoming a professional in something. And what I mean by that is when I decided to get into finance and investing, I started to meet a lot of people in the industry who have spent their whole lives learning this stuff. These were successful, hardworking people in nice suits, wearing nice watches, using tons of complex sounding words, and frankly, they were intimidating and discouraging because I just couldn't imagine how a human being goes from not knowing anything about finance to becoming a successful venture capitalist or a certified financial planner or anything else. All I knew was that I knew nothing, and these people seemingly knew everything. And I just couldn't fathom the amount of experience and time and the processes it took to get from where I was to where those people were. And that made the little baby steps I was taking by reading articles and watching the news seem futile. And this was a pretty bad perspective to have as a learner. Nothing I did felt like it mattered because on a day-to-day basis, I felt no closer to being classified as a professional investor, even after being involved in this world for over 2 years. And so yeah, what I'm about to show you is the beginning of a person going from knowing very little about finance to knowing more than a little. I'll be showing the frustrating, ugly, very boring side of learning. And I'm not claiming I'm any good at it right now. I'm not trying to give any implication that I'm about to show you the secret to getting knowledge. You'll probably see that I'm a very bad learner, and all I can say to that is I'm learning to learn better. And with all that said, here's me learning the different ways you can buy or sell a stock. What is going on? Okay, hello. So today we're gonna be researching, or I'm gonna be researching all the different ways you can buy a stock because I've been doing this, or I've been in this field for the last 2-ish years, and I still don't fully understand what options are and probably a few more things. And so I just wanted to actually spend some time to figure out what those things are, because I've been in a lot of conversations where people are like, I bought 10 puts on such and such company, and I'm just like, oh wow, but in reality I just don't know what they're talking about. So I'm sure it'll be a pretty simple thing, but yeah, I just wanted to start with this because I figured we're talking about investing, we're talking about learning investing. A good place to start seems to be how to buy stocks. So yeah, let's begin. Okay, so I looked this up because I was expecting basically just you can outright just buy stock, and there's a couple of variations with that. You can do limit orders, you can do market orders, you can do a couple different things, and you can buy on margin, you can short sell, you can do options, which I've heard of all those before. Never heard of synthetic or indirect exposure. Oh, okay, actually I have. I know what these are, but I've never seen it written like this. Derivative strategies. You can find the above. Okay, so this is like a. I don't know what this is. Alternative ownership structures, employee stock options. Discount. Okay. I'm gonna assume that oh, okay, I see. Never mind. I kind of know what this is. The main things I wanted to look over are these first four. So just buying stock directly, buying on margin, short selling, and options contracts. So I think we'll narrow down to these four and then go from there. Yeah, so start with that. I like to pull up a few more of these just to fact check. Well, I don't do this all the time, but I should. What are the other ones? Gemini. Let's do Grok. This is probably enough for now. I mean, I don't think you even need to do 4, but I'm just gonna. I've never used much of Gemini and Grok, so I feel like I should try now so I can get a feel for which ones are gonna be most useful for me. This is being a little bit too broad, so what are the different ways you can buy a stock directly for a normal retail investor? Okay, this looks good. I am gonna copy this. Oh, oops. I'm gonna copy this whole prompt, and I'm gonna paste these into these other guys, and just make sure they all say similar things. Okay, I mean, this one's saying perplexity saying similar things as this over here, which I guess that makes sense. Google Gemini, market order, limit order, fraction of series, recurring investment, stop order, stop limit order. Okay, yeah, these are all the options I was expecting. So I know what market orders and limit orders are, because market order is just like, I feel like the first thing you do when you first try investing, which is apparently you shouldn't really do market orders. You should do limit orders. I have a general sense of what a stop order is or a stop limit order is. I don't know what a trailing stop order is. Maybe I need to be more specific with my question. Okay, this is what I wanted to see. I'm gonna actually copy this question into these guys. Oh shoot. And I may stop this at some point. Like, stop asking all these guys all these questions at some point. But for now, let's just. We'll go with this table for now. Oh, actually, this chart is really nice. Yeah, so market orders buy instantly at the current price. Yeah, this is the fastest and simplest. There's no price control, which is a huge, which is kind of a big deal as far as I can tell. Limit orders, you buy at or below a set price that you decide. Yeah, and they execute when the price hits the limit that you set. Yeah, key benefit, control over the price, main risk, may not fill. Oh, yeah, okay. Stop orders, converts to market order when price hits trigger. Okay, so stop orders are actually, okay, I see. Let me just read through this for a second. Okay. Of the options in these charts. Explain how certain options are similar So I'm a little bit confused on the stop orders because like for the stop order, stop market, or the stop order, here it says executes above your stop price momentum entry. So I feel like this implies that you set two. Oh, never mind. Okay, so you just set a price on these stop orders so that if a stock's value starts to like spike upwards, you automatically buy from a certain price at market price. So that's what they mean by momentum entry. When the stock is gaining momentum, you will automatically buy from a certain price onwards. And I'm assuming for small orders, that's not a big deal. But if you're buying a lot of shares of something, then you could get a huge range in the different prices of stocks, or the different prices that you're entering at a certain stock, because there may not be enough enough people selling at the stop value. Trailing stop order seems interesting. I feel like I'm having trouble imagining what that looks like. I'm gonna look a little bit more into what a trailing stop order. Okay. I'm going to try to explain all these different options now. There's 5 I'm going to go over. There's the market order, limit order, stop limit order, and trailing stop order. So I know what market orders and limit orders are too, but I haven't really ever tried stop orders, any of these 3 different kinds of stop orders. And so those have been a little bit mysterious to me, but now that I've read through them, they make a lot of sense actually. But yeah, let's see if I can just kind of roughly explain them off the top of my head. So I'm just gonna not look at the screen and say, so market orders are when you just buy a stock at whatever price it's currently at. And those are nice because they're very simple and they're very quick. But the downside is you can't really select, you have no control over the price that you're buying at. The limit orders are when you set a certain price that you want to buy or sell at. I should have mentioned that with the market order too. It goes for buying and selling. So limit orders, you set a certain price that you want to sell or buy at, and those are nicer because you get control over the price, but one of the cons of limit orders is that sometimes you set a limit price to say like buy something at a certain price. So say like I want to buy a stock at $100. I set a limit order for $100. It's currently at like $130. And then there's like a bad day for that company and they go down to $101 and then they rebound back upwards. In those scenarios, limit orders can be, that can kind of suck because you were like this close to buying at like the bottom of the dip, which is a good time to buy a stock. But because you set a limit like right at a point that it just barely didn't reach, you never got to buy the stock. That's kind of one of the cons of limit orders. Same with when you're selling. Like you may set a limit so that it sells. Say this $130 stock goes, like you set a limit, sell to $160, and it reaches $159 and then just drops to like something ridiculous like $10 and it never comes back up for the next like 10 years. That's like kind of a nightmare scenario, but that's a very possible con of limit selling. So stop orders are where you set a stop so that if a stock reaches a certain price, from there on you will automatically buy or sell at market price. Once that stock passes that stop limit that you set. So if you have this $100 stock and you set a stop, buy order where once it reaches $105, you'll just start buying at market price, then the stock goes up to $105.01, and then you start automatically buying. The nice thing about that is you're buying into any momentum the stock is having, but the not as nice part of that is that you may be buying at much more expensive prices than just past your at your limit. So say you set the limit at or the stop at 105, but the stock goes up to 120, 130, along the way you'll keep buying at 105, 106, 107, 108, depending on how many shares you're buying. And that could kind of bring up your average price of that stock a lot, which if you're buying small amounts probably won't affect you too much, but if you're buying a lot of shares of a certain company that way, then you may end up getting an average price on those stocks at, instead of 105, I don't know, something higher, just 107, 108, 109. And then a stop limit order is where you set a stop price so that, if I use the same example, you set a stop price at 105, you set the limit to 106, I guess, and if the stock goes from 100 to 105, you'll start buying, up until the point where it goes past 106. So you'll never buy any stocks past 106. Um, and so that's nice because you get more control over the price. But if you're buying a lot of shares, again, like you may not end up being able to buy all the shares you want because not enough people are selling them at that price, that limit price that you set. And so, yeah, the pro is that you get to set the price, you have control over the price, but the con is that you may not be able to execute on all the shares that you want. Trailing stop order. That one's actually pretty new for me. Or that, I mean, this one's not like new, but it's the most unfamiliar one to me. But this one is essentially where you set a, I guess would you call it a range? Follows a. It, it's like a stop or like a limit. I mean, it's a stop. It's a stop that you set based on a certain percentage of the value of the stock. And so I can probably put my hand down. I don't know why I'm keeping this here. So if you say you have this $100 company, $100 stock, when I stare at the camera, my brain turns off. You set a 5% stop limit, I guess. I don't know what you'd call it. A 5% stop trail, maybe. And if you do a buy, then as long as the price goes down, that trail will follow at 5%. And so say it starts at 100 and you set a 5% trail, that means, shit, what does that mean? This is one I was most confused on, so. Trailing stop buy order. Tesla, so okay, this example is saying Tesla at $200. If you believe it starts rising, it could keep going. You place a trailing stop buy order with a $5 trail. Oh yeah, so you can do a percentage or you can do a flat dollar amount. But in this case, we're doing a flat dollar amount. You place the order when Tesla's price is at $200. The trigger price, which is the price at which this order will execute, is set at 205 because we're using a $5 trail. So if the price drops from here, so the price of Tesla's stock goes to 195, the trigger price will trail along that as it moves down. So it goes from 200 and 205 to 195 to 200. And then if it goes back up, then the trail moves back up because you set it at this price, but if it starts to jump higher than the original price, the original trigger will be reached and the market will execute that buy order and then you'll buy at $205. And so the idea for a trailing stop buy order is that you're trying to get in whenever momentum starts to build. Okay, and it's basically the opposite with the sell, obviously, but I'm still a little bit confused on. Yeah, so the stop followed your gains upward but didn't move down when the price fell. So wait, let's look at this example. So if you were buying Apple $100 your trailing sell order will be 95. But if the price of your stock goes up, the trail moves up with it. It goes up here and the trail moves up. The second it goes down, the second the stock value starts to go down, the trail will fix, and then if the price drops below that fixed trail, you'll automatically start selling. And the idea of this is that if it's just to like lock in gains, because there's a lot of scenarios where you buy a stock and it starts to go up a lot, and you're holding it, you believe in the company, and then the stock price drops way below the price that you dropped at, and it just like doesn't return for a long time. That could be that can hurt. And so people will do this to just lock in the gains they have. At the cost of risking like essentially missing out on like a moment where the stock price goes up and then it drops a little bit and then goes way up higher. You'd be missing out on a scenario like that, but I mean, there's things you can do to also prevent that scenario from happening. I mean, there's a lot of things you can do. Fuck. I don't even know if I should be trying to explain this stuff. I'm gonna ask a follow-up question just because I'm not feeling 100% on these trailing stop orders. Only because in this example, like this makes sense to me. Like if you're putting a sell, if the stock price rises, the stop price, the trailing stop price moves up with it, and the second it starts going down, the trailing stop price stays fixed, and then if you reach that trailing stop price and go past it, then you automatically trigger a sell and you lock in your gains. That makes sense to me. But in this example, on the trailing stop buy order, whenever the stock price goes down, the trailing price goes down with it. And then, so that's here, and then on this step, it goes down again and the trail price moves down with it. And then the stock price rises from 195 to 200, and the trail seems to move upwards with that instead of staying fixed, which I might have an idea as to why that's the case, but that's very different from this situation where the trail only follows in one direction, whereas in this, the trail follows downwards and upwards. So I'm going to ask a question clarifying that. For a trailing stop order, what are the conditions in which a trail will follow, or I guess trail, a stock's movement? In the sell order, it seems like the trail only follows when the price is going up, but on the buy order, the trail seems to follow both the upwards and downwards movement of the price. Trailing stop only trails the price in the direction that improves your position. For a sell order, that means price going up. For a buy order, that means the price going down. Whenever the price moves against your intended trade direction, the trail freezes. It no longer adjusts until the price reverses again. So trailing stop sell is for protecting profits. It's used when you already own the stock and want to sell if it falls too much. So if the price goes up, the stop price moves up by the trail amount. And the stock price goes down, the stop price stays fixed. That makes sense. For the buy order, so yeah, it's used when you don't own the stock and yet you don't own the stock yet and want to buy if it starts rising. So price goes down, the stop price moves down by the trail amount. Price goes up, the stop price stays fixed. Okay, so that is how that works, but in that example that it showed, it didn't seem to do that. So that's what was confusing me. Okay. That makes sense. Why did it give such a... Am I crazy? What is this example? Maybe this was just like a terrible example that ChatGPT had a brain fart on. Maybe ask one of these other guys. How does a trailing stop order work? I feel like this is a terrible explanation. What is a trailing? These are always good questions whenever you're reading stuff about like investing. Like if you're ever looking into some method of investing, one of your first questions should be, what are the risks associated with this strategy or method or whatever it is. Okay. I think I get these now. I'm going to talk about the 5 different types of just straight out buying a stock, which is market order, limit order, stop limit order, and trailing stop order. That is everything, right? I swear there were more earlier. Okay, yeah, those 5 things. I'm going to be going over the 5 different ways that you can just buy a stock, buy or sell, and that is market order, limit order, stop limit order, and trailing stop order. These are like generally all the options you'll see when you go to buy a stock. And so now that I've read through all these, I think I have an understanding of them. Let's see if I can just explain them back to you, or to myself, I guess. Um, so a market order is when you just buy a stock at the current price that it's at, and the benefits, the pros of that is that it's quick, it's simple, but the con is that you don't really get control over what price you're buying at, which can be a pretty big deal. A limit order is when you set a certain price so that if the value of the stock reaches that price, then you will automatically buy or sell. And the pros of that is that you get control of the price, so you're not buying too low or selling too high. Or, I mean, you're not buying too high or selling too low. And the cons of that is that it won't always be instant, and you won't always fulfill your order, because sometimes the price of the stock may like barely not reach your limit, and then just like go the other way, and it just like your order will never be executed. So that's kind of the risk of that. The stop order is when you set a stop limit so that if the value of the stock reaches that limit and goes past it, then you will automatically buy or sell at market price. And yeah, the pros of that is that if you're doing a stop buy order, that means that you're buying in you're probably buying into like the momentum of a stock. If it's starting to like shoot up, you'll start buying at a certain price so that you don't have to end up buying when it's like if the stock goes up like this, you're buying like down here instead of like up here, ideally. And if it goes down a bunch, then you're selling up here instead of down here. Yeah. And a stop limit order is pretty similar to the stop order, but instead of doing a market buy when you hit that trigger price, I believe you set a stop price and then a limit price. So that, say you go to buy, you have a stock that's worth $200, and you set a stop, like a sell stop at 195 and a limit at like 190. So if the stock goes from 200 to 195 down to like 160, all the shares that you sell will sell at between 195 and 190. So you're never selling at lower. Actually, maybe that's a bad example. Was that a bad example? Honestly, I can barely remember what I'm saying sometimes. Let's just restart. A stop limit order is when you set a trigger price, and if the stock reaches that trigger price, it will automatically start to buy or sell within that trigger price and that limit price that you set. So unlike a normal stop order where you could buy or sell in a big range from the trigger price, you are buying or selling within a certain range of price, so that if the value of the stock goes past that, then you're no longer buying or selling. And that can help protect you it can help protect you. Um, I think that's maybe a fine enough explanation. The trailing stop order is when you set a certain trigger price. Oh, no. The trailing stop order is when you set a certain trail, which can be a fixed dollar amount or a percentage of a stock price. And depending on if you do a trailing buy or a trailing sell order, the trail will follow. So the trail will follow only in the direction that's beneficial to the order. So if you're doing a trailing buy order, then the trail will only follow the value of the stock as long as the price is going down. As soon as it starts to come up, the trail will stop, and then once you reach that trail amount, it'll start to buy there. And that's ideal because you for the most part, you want to buy stocks when they're cheap and sell when they're high. And so doing this trailing buy order will make it so that you kind of automatically just buy at like a relatively low price. Yeah. Actually, maybe I didn't need to include that information. Okay, restart. A trailing stop order. Fuck. Okay. Restart. Okay. A trailing stop order is when you set a fixed dollar amount or percentage called a trail on a certain stock. And so depending on if the stock price goes up or down, if you put in a trailing buy or a trailing sell order, the trail will follow in the direction that's beneficial to your trade. So if you are doing a trail buy order, then when you say the value of a stock is $100 and you put in a trailing buy order with a trail of $5, that means that if the value of the stock goes down to $95, then the trail will follow downwards $5. So when you started the trade, when the price was $100, the trail is at $95. And then when the stock dropped, oh shit, I may be messing this up. Oh, okay, wait. I was explaining that fine, I think. Okay, let's restart again. So a trailing stop order is when you set, it's just a variation of a stop order, but you set a trail, which can be a fixed dollar amount or a percentage. And when the stock value goes up or down, the trail will follow alongside until it hits like the trigger price and executes a buy or sell. But it depends on if you're doing a trail buy or trail sell order. And so just to make it clear, when you're doing a trail buy order, trailing stop buy order, what you're doing is if the price of that stock is $200 and you set a trailing buy order and you set the trail as $5, then when the value of the stock goes down to $195, the trail will also go down $5 because the value of the stock went down $5. And if it goes down again, the trail will follow alongside. And then if the value of the stock starts to go up, the trail will stop following and it'll lock in at that last lowest amount. And then if the value of the stock reaches that price, it'll automatically start buying. And so this is just, again, a variation of a stop order, but it can be nice because it gives you a little bit more. I think it just gives you a little bit more. Like if you were to just set a stop order on like a buy, then when the price of that stock goes, in the same example, if the price of that stock goes down from 200 to 195 and you just set a buy order for like this $5, like a cheaper, $5 cheaper than the stock price, it'll just buy at 195. But if you do a trailing stop order, you might end up buying at like 190 because the value of the stock went down past 195, down to 190, and then it started to go up. And so in that way you can get a better price. But oh man, I don't know if any of this is really making sense. I'm having many doubts, but I don't know. It may not look like I get it, but I'm pretty sure I get this now. So I'm just gonna move on because I feel like I'm just like I have myself in a loop right now because I'm not like I'm pretty sure I get it. These make sense to me, but maybe I can't explain it right now because frankly I feel very stupid explaining it right now. But the confusion and the questions in my head are gone, and so I'm pretty sure I get it. So let's just move on. Other than the normal types of just buying a stock, there are these other three ways. So there's margin buying, there's short selling, and there's option contracts. Buying on margins, I kind of get because this is something that. Okay, you know what? Before I talk and make a bigger fool of myself, let's just get some basic questions asked and answered. My brain's so fried right now for some reason. Buying on margins. So I have a general idea of how margins work because I had just helped set up a margin account for my dad with one of our banks, and this explanation here is confusing me a little bit. So let's just. I'm pretty sure this is a dumb question. I'm pretty sure the answer to this is that the act of buying on margins is a form of leveraging. But just to make sure, I'm just asking. Buying on margin, so you could with your own cash. Leverage is the effect. It's the ratio between the total value position and your own equity. Okay, margin is a mechanism. Leverage is the result. Yeah. Okay. Okay. Yeah, this one I feel pretty okay with. Let's go back to where that was. Way up here. No, it's like way up here. So buying on margins is essentially when, um, like you're taking out a loan on collateral, which tends to be like other stocks that you own, but it can be other things. But I think most commonly people will like leverage off their other stocks in order to buy more stocks. And or I think the next common option is like real estate. But essentially what you're doing is you're you're using the stocks that you currently have as collateral to get a loan to buy more stocks. And so like that can be very helpful for like people like my family, because most of our a lot of our cash, like most of it is it's already invested. And whenever there's a good opportunity to buy more stocks, we just don't have the liquidity to just buy more of those stocks when the prices are good. And so what people like us will do is we'll buy on margins. I don't know how to phrase this. Essentially, so say we have like $100 million in a certain stock, and there's this other stock we've been interested in, and the price of that stock just went down a bunch, and we want to buy it, but we don't have enough cash to buy an amount of this stock that we want to buy. And so with this $100 million invested, what we'll do is we will leverage it and essentially get a loan, maybe at like 50% of the value of this already, or these like stocks that we already have. And so we'll get like a $50 million loan essentially in order to buy this other stock. And so the obvious pro of that is we don't have to sell any of this original $100 million in stocks to be able to buy this. We can have this and this. But the problem is, if the value of this original $100 million in stock goes down too much, then we could face something called a margin call, which it's like essentially a way for the bank in this case to protect themselves, because they're loaning us a large amount of money. And this is all like negotiated with the bank, but say this stock that I had $100 million worth was worth $100 a share. We can make like an agreement with the bank where they're like, okay, we'll lend you like 50% on this position that you have, this $100 million. So we'll give you $50 million, but if the price of this stock goes down to, I don't know, just arbitrary numbers, like $60, then we will do a margin call, and say of this like $50 million loan, you invested $10 million worth of it into this company you wanted to buy, then the bank, in the event of a margin call, will sell off $10 million worth of this company, of these shares that you have, and they'll take that. And so that's sort of the big risk in buying on margins. Okay. Oh, this is like where this gets kind of embarrassing because yeah, there's like I need to ask some questions and they feel so stupid, but I need to ask them because otherwise I'm not gonna understand. And staying on the topic of margin buying, the what does a margin call look like? What would that process look like? I'm gonna take a break. I'm gonna maybe read. Uh, I just need something else than staring at my screen. So yeah, I'm gonna be right back. Okay, this is day 2. I only got through about an hour and a half yesterday before I just felt burnt out, frankly. Um, so not the longest amount of time, but I don't know, something about having to explain what's going on in my brain as I do the research was very draining. I think I just felt I think frankly I just felt too stupid for an hour and a half, like talking out loud. Um, and yeah, I just needed a break. I have a meeting later today with a financial planner because we opened a margin account recently, and I haven't gotten the chance to speak with them, ask them a few questions. And so honestly, we left off on I left off on a good place yesterday because I was on margin borrowing, and it'll be good to just kind of learn more about it and think of some questions before my meeting. I don't know. I guess we just begin. I guess we just begin. So, okay, where was I? What happens during a margin call? What's my last question? Staying on topic, what does a margin call look like? What would that process look like? Okay. In this example, in the step-by-step example, in the event of a margin call where my equity ratio goes below the 25% minimum, say it goes down to 20%, what exactly do I owe the bank? Okay, so I'm gonna be writing down some questions that I'm gonna be asking my financial planner later. Okay. What is our maintenance? What is our maintenance requirement? I think they said this somewhere in one of our emails. I'll probably look before. I mean, I'm definitely gonna look before the call, but that's just something that I don't know off the top of my head right now. Okay, so what I'm confused about here with the margin calls is, so I get that if your equity drops below a certain requirement, you then have to either, and then the bank issues a margin call, you either have to deposit more money from like one of your accounts into that account to then bring your like get back above the maintenance value, or you can sell off the stock that I'm assuming you collateralized until you're back over that threshold. But what I'm confused about is like what money goes to the bank? If I sell off stock to get back above that threshold, that maintenance threshold, then is that selling of the stock, am I just getting cash just for the sake of getting above that maintenance amount, or am I selling that off and is that money going to the bank, or is only part of that money going to the bank? And I'm sure they've said it here, but from what I've read, I don't have a clear answer to that yet. So I'm gonna inquire more into that. Honestly, I could just save all my questions for my meeting later. That could be pretty helpful. Actually, no, but I do want to kind of show you guys me figuring it out. So I guess I'll try to figure out things here first. Okay. There's too much information here that I'm just okay. Let's start over. I'm gonna use the mic feature actually. Let's start over. I want you to explain exactly how margin borrowing works, but I want you to simplify it because you're giving me too many like formulas and jargon, and I just need to know in the event of, so if I open a margin account, say with $100 million in Apple, like I use $100 million in stock of Apple to open a margin account, that's my collateral, and then the bank offers me like 75% of margin borrowing against that collateral. So I can use $75 million for margin buying or borrowing. And I use 25 million of those dollars to buy $25 million worth of Microsoft stock. What needs to happen for a margin call to occur? And in the event of a margin call, where does that money go? Does the sum of it go to the bank? Does it all just go back into my margin account until I get back above the maintenance margin value? Or yeah, how does that work? So you still own your 100 million Apple stock. Okay, I got that. The broker now has lien on it. They can sell it if needed. So I guess, yeah, lien is just the power for them to sell it if needed. You take out a loan from them secured by the Apple stock. You decide to borrow 25 million instead of the full 75 million, and buy $25 million of Microsoft stocks for your portfolios now. Okay. Total assets 125 million. Your debt is 25 million. Your equity, your money, is 100 million. Margin call happens when the value of your collateral drops enough that your equity falls below the broker's required level. Okay, that makes sense. Think of it like the broker lends you money, your Apple stock is the collateral. If Apple's price drops too far, the value of the collateral isn't enough cushion anymore. So say your broker requires that you keep at least 30% of your total portfolio value as your own equity. Okay. So I get this first line so far. If I have $100 million, I borrow $25 million, and so now I have $125 million worth of stock, and $25 million is the borrowed stock, then yeah, my equity is 80%. Apple drops 40%. Okay, so then the value of this drops to 60 million. Microsoft is the same. Total assets is 85. That stays the same. My equity is 60 million. My total equity is now 71%. Apple drops 60%, so I drop down to 40 million. This stays the same. Total assets is 65, same. Your equity is 40 million, so now you're down to 62%. Okay, this makes sense to me now. I didn't realize that this was the way they, like this number, this equity percentage was what triggered the margin call. I knew that some value had to be above a certain percentage, but I didn't know exactly where that value came from. So now I know. What happens when a margin call occurs? A broker will notify you that your equity has fallen below the maintenance requirement. They'll tell you something like deposit 5 million or we'll sell securities to bring your account back into compliance. Okay, I get how this process works. I shouldn't point at it. I get how this process works, step 3. And now what I'm curious on, the reason I asked this question is if I add more collateral or reduce the loan by selling some of my Apple or Microsoft stock, this repaying part of the $25 million loan, I am confused on like what this money goes to, this repayment part. Like if it's just a matter of changing the equity percentage in my account, or if it's a matter of paying the bank a certain amount in the event of a margin call. It might be both, but hopefully it explains here on step 4 and 5. If you don't know, if you do nothing, if you don't act, the broker will sell some of your holdings automatically, usually whichever is easiest to liquidate. They might sell $10 million worth of Apple stock. They'll use the proceeds to pay down your margin loan, lowering it from 25 million to 15 million. The leftover value stays in your account as reduced collateral. They're not taking your money away in the sense of pocketing it. They're using it to repay the money. They're using it to repay the money you borrowed from them because your collateral isn't worth enough to cover the loan anymore. Where the money goes, that's the part most people misunderstand, apparently. I mean, I don't, if you say so. The margin loan is literally the money the broker lent you. When a margin call happens and securities are sold, the sale proceeds to go straight back to the broker to reduce or repay that loan. Whatever remains stays in your account as your equity, your remaining holdings, so the money doesn't disappear or get taken. It goes toward repaying your debt to the broker until your equity percentage is back above the maintenance margin. Okay, so parts of this sound like it's saying that I'm not really paying the bank anything, other than I'm assuming. Actually, I'm just going to cancel what I was about to say. But then there's also parts of this that I feel like imply that you are paying something to the bank. I know that, like, since you are doing a form of a loan, you're paying interest, but that interest should be relatively small. And so I would assume, before I dig deeper into this, that in the event of a margin call, you pay off any interest from your loan, and you try to bring back the value of your equity to above the maintenance margin. Let's look at the summary. Use borrow on margin, broker lends you cash secured by Apple stock, loan added to your account, stock value drops, collateral loses value, your equity percentage drops. Margin call issued, you're under maintenance margin. Broker asks for cash or sells holdings. Sorry, I just lost focus. Margin call issued, you're under maintenance margin. Broker asks for cash or sells holdings. Broker sells your stock, proceeds used to repay your margin loan. Money goes back to the broker. After call resolved, remaining assets equal your new equity. You keep what's left. Okay, so in regard to, in this summary that you provided, the last two parts where the broker sells your stock and the after call resolved bit, in this example, how much of those proceeds would be used to repay your margin loan? Let's say the interest rates that you were paying on that loan were 5%. Can you show me exact numbers on where the money's moving? How much of it goes to the bank? How much of it goes to your account? Broker decides to sell 10 million of Microsoft stock to bring you back above 40%, which means that this would be 20, this would be 15, and so this would be somewhere like high 50s, 60s% of your equity, which means you'd be back above the 40% level. Oh, it's based on the loan, how long the loan was outstanding before the margin call. So it's not just, I assumed that you'd be paying interest month by month if you've used part of the loan to invest in another stock. And so by the time you're at the margin call, you would only be paying a month's worth of interest, assuming you paid off the other months. But this example is saying that it's implying that, I feel like it's implying that you didn't pay interest on your loan the whole 6 months before your margin call, and then you're just paying it all at once at the margin call event. Okay, so they are, I mean, in this it's saying that, like at first I was a little scared about this because I thought it was saying that you pay the bank the 10 million in principal plus that interest amount. But actually what it seems to be saying is that since you sell $10 million worth of the Microsoft stock in this example, where did it say that? Right here, $10 million of Microsoft stock. I thought it was saying that 10 million goes to the bank plus the interest that you owed the bank from that loan. But it seems to just be saying that that 10 million goes back into your account. I mean, oh, actually, maybe it is saying that. Oh, yeah. that 10 million is deducted from your account because you have to pay off the principal. So you're down 10 million from 45, so it's 35 million minus the interest that you owed. So you're now down to 34 million, 0.375 as opposed to $45 million. Okay, that's pretty rough. Final snapshot after the call. So it'd be, yeah, okay, so it looked like this. 20 million, you still held this because you didn't liquidate this. Microsoft went from 25 to 15 because they stole 10 million off because of the margin call. So yeah, total assets are 35 million, margin loan, $0 because it was paid off. Interest paid to broker. This gets subtracted from your total, and then yeah, you get 34.4. Okay, so my next question is, in this example, you're selling off $10 million worth of Microsoft stock. My next question after reading all this is, I wonder if in the event of a margin call, typically the broker or the bank will sell off enough stock or ask for a deposit to reach just at the maintenance margin value, or if they want you to be above a certain like threshold above it, so just for like safety, so that if your stock drops another few percentages, you're not getting another margin call like the next day. Which I'm assuming that they would ask you to go a considerable degree above the margin maintenance value, or the maintenance margin value. It's all these words. But then how much is that value? Like how much above 40% in this example do you need to be for the bank to be happy? I'm assuming that also depends on the bank, your relationship with the bank. But I'm wondering if there's like a standard amount they usually want you to be above. So let's ask that question. Actually, okay, so I have two questions. I'm gonna write them down. In the event of a margin call, how far above the maintenance margin value do I need to get to? Does it depend, or is there a standardized value? I had another question on, yeah, okay, so I want to know why you're just flat out paying the bank 10 million in this example. Like, cause it can tell me like, yeah, in the event of a margin call, you repay the interest that you owe and the principal, like some principal amount of the loan, and that's just how that works. I can get that, but then it's like, why? Like, why? Like, I'm not sure if that made sense. I just find this to happen to me a lot when I'm trying to learn about this stuff. Like reading it just at face value, it generally makes sense. Like yeah, I can read like the summary of money movement thing. Like I can read this, like sale of Microsoft stock 10 million goes to the broker, used to repay margin loan minus 10 million, which reduces your loan from 25 million to 15 million. Ongoing interest for 6 months at 5% is 0.625 million. You pay that to the broker. And your remaining assets after the sale are 34.375 million, which stay in your account. I get that. I can understand that. But then what happens to me is like, why do I pay the bank 10 million? And that's usually because there's a lot of information that like people in this field probably already know, just like as a baseline default sort of knowledge. But I didn't learn this stuff, so I've basically like skipped over the beginning portions of learning about finance and investing. And instead of starting from here and then like working my way upwards here, I just started from here and then I just jumped up to here. And so I'm learning information at this level, but all this information that should have been learned beforehand, I just don't know. And so like for the longest time, I didn't understand at all how interest rates worked. And I probably still don't really know. Like I would never feel confident right now to give a lecture on interest rates. Like, and I'm sure, like, I don't think that's what should be expected of me. But I would just like to know how those things work because they're so involved with pretty much everything that you do in investing. And so yeah, like this question I have here with like why am I paying the bank 10 million in this case? It'd probably be really easy to understand if I just kind of knew how loans worked in the first place. But I don't. And so I just don't know the logic and reasoning for why this is being paid to the bank. And that will be very apparent in many other things as you all see me research this stuff. So I'm just putting that out there. So I don't even know how to frame this question. I'm just going to be very straightforward with it. Okay, wait. Why am I paying the bank $10 million in this example? What are the reasonings behind that? This is the worst, when like you're curious about something but you don't even know how to ask the question. So we'll just start with something and then see if things get a little bit more clear. Okay, when you buy on margin, you're not just using leverage. You're literally taking out a loan from your broker. The loan has to be repaid and your stocks act as collateral. So when the broker sells $10 million worth of your holdings in a margin call, that money goes towards repaying the loan you took out from them. Not because they're taking your money, but because they're collecting the money they lent you in the first place. Okay, that feels like that makes more sense. I just need like, this sentence just cleared a lot of that up. And it's like very straightforward. Like I kind of assumed that this would be it. This would be sort of the answer, but I just like, I don't know for sure. And so it's just very ambiguous in my head. Before we continue, like the part that confused me initially, like I understood that it was the bank's money, but what I was curious about was why can't you just not pay that loan at that time? Like why? And you know, as I'm asking this question, I'm realizing that I think it's because in that example they gave us, it was showing us what happens in the event that we don't have the cash to deposit back into the portfolio to get the equity past, like back above the margin, the maintenance margin amount. And so that example was talking about in the event that you can't pay off, you can't increase, like get back above the margin, the maintenance margin value. Oh, fuck. Uh, I just feel the need to like defend myself or something. I'm not I'm not dumb. Like I'm not literally dumb. But for some reason when I'm like reading this stuff, my brain just gets very like scattered, and I have all these like bits and pieces that aren't fully understood, and so when I try to frame a question or try to like connect them together, I just get stuck, and then this happens. So um, just give me a second. um, okay. Let's just continue. So if you don't add cash, your broker steps in to protect themselves. They sell 10 million of your Microsoft stock. Why that amount? Because they need to reduce the loan exposure, 25 million you owe them, and bring your equity ratio back above their 40% safety line. When they sell 10 million of that stock, the cash proceeds go directly back to the broker to pay down the loan, since that's where the debt sits. After that sale, you owe less money, 15 million instead of 25 million. Your collateral, remaining holdings now more than covers that smaller loan. You're back within the margin requirements. Okay, that makes sense. So why are you paying $10 million to the bank? Because that $10 million sale represents repayment of part of that 25 million you originally borrowed. You're not losing an extra 10 million, you're returning 10 million of the borrowed money. It's the same as paying down any other loan when your collateral falls in value. Okay, so this brings up a question for me. Is this like, I was under the impression that if you're doing this margin borrowing thing in this example and you're collateralizing your Apple stock, that in the event of a margin call, you have to sell your Apple stock or you have to deposit more cash. I didn't realize that you could just sell off the stock that you borrowed, and so I'm just gonna make sure that's true, and like my family would be able to do that in the event of a margin call. So I'm just gonna write that question down so I can ask our financial planner later. I'm going to ask, in the event of a margin call, we have 3 options: deposit more cash, sell off the collateralized stock, or sell off the borrowed stock. That's what I'll be asking. Also, I think this answers my question now. Yeah, sometimes it's not even that like I straight up like can't understand what's going on with like when I was over here. Like I was very confused when I was talking at this point, but it really just comes down to like I just need to physically see or read the reasoning behind that, because otherwise there could be so many reasons. There's like, frankly, this finance stuff can be pretty bullshit sometimes. Like you think for a lot of things that if this happens, logically this should happen, but in finance it goes from this to like this, which then goes off to this and then back to this. But then this is really that, which makes no sense to you. But that's what I feel like happens to me a lot in finance. So I just need that clarification. And I got it here. So this makes sense to me now. You sell 10 million of your Microsoft stock, the proceeds goes to the broker. The broker uses that 10 million to reduce your outstanding margin loan from 25 to 15 million. Fair enough. The rest of your portfolio, now worth about 35 million, remains in your account as your equity. Okay, got it. I'm gonna go back to the definition from yesterday on margin borrowing, and I'm just gonna make sure that I don't get any questions from there. So let's see. Buying on margin. Borrowing money from your broker to buy more shares. You have $5,000 and you borrow another $5,000 from your broker to buy $10,000 worth of stock. Amplify gains if stock rises, but also losses if it falls. If stock drops too much, you might face a margin call, forced liquidation. Okay. That actually all makes sense to me now. Yeah. That feels nice. That feels nice to have clarity on margin borrowing again. Well, not again. Margin borrowing now. So I guess we can move on. Short selling. So I actually looked into this a lot when I was writing my first video, or like my first real video other than the introduction. So I'm just gonna read through this and just make sure there's no more questions, and then if I have no more questions, I'll move on. Short selling is betting against a stock. The betting against is important because when I just went into this big explanation on what short selling is, and I just started to like branch off into different tangents, and I kind of lost myself, so I'm just gonna restart. Short selling, I get. I think that's all I need to say, but I feel like I need to include some information about it. When you buy a stock, normally you're hoping that the price goes up. So you're hoping that the company does well, because when the company does well, the value of their stock goes up. But when you're shorting a stock, you're hoping that the company does poorly. You're betting against it, which companies don't really like, but it is a way for investors to make money off a company that's going through some hard times. And how this process works is you borrow shares from a lender or a bank, and you immediately sell those shares. So ideally you sell them when the price is relatively high, and then at some point in the future, you have to buy back those shares, ideally when they're cheaper, and then you keep the difference in that price and you give the shares back to the lender. And so yeah, short selling. So in an example, say you buy $100,000 worth of stock, valued at $100 a piece. You borrow that, you immediately sell it off. So you now have $100,000 in cash. And then you wait. One day the price of that stock drops down to $80. And then you buy back the same amount of shares that you sold originally. So if you borrowed $100,000 worth of a stock at $100 a piece, that's 1,000 shares. And so when it drops down to $80, you then buy back 1,000 shares at $80 a piece, which is $80,000. You send those shares back to the lender, and you pocket the remaining $20,000. That's how short selling works. Okay, options contracts. This is kind of the main reason I wanted to do this. This is one that I know least about, so this will be pretty new for me. So, options contracts. Let's just read through this. First. These are derivative contracts. I already don't know what derivative is. Actually, I know what a derivative is, but I don't know what it means in this context. These are derivative contracts giving you the right, but not the obligation, to buy or sell the stock at a specific price before a certain date. Okay, so this is another example of like, I read the sentence, it makes sense, but I have no idea the reasonings and the logistics of how all this works, so it also kind of doesn't make sense in a way. So, like, okay, it makes sense, but I don't understand it. Call options are right to buy. So I know that you can do calls or puts, and puts are, yeah, right to sell, and calls are rights to buy. So calls are for when you're bullish, and if you're doing put options, it's implicit that you're bearish on a stock. So call options are right to buy. You buy a call option on Apple with a $200 strike expiring next month. If Apple rises above $200, your call gains value. If it stays below, the option expires worthless. A small premium can control 100 shares. I have no idea what this means right now. Put options are right to sell. Buy a $200 put. If Apple falls to $150, your put increases in value. Okay, like again, this makes sense. I don't understand it though. Selling options, you can also sell right options. Maybe I have heard of that. Covered call, own the stock and sell a call to earn income. Cash secured put, sell a put to collect premium and potentially buy the stock cheaper. Naked options, selling without owning the underlying stock, high risk. Okay, I don't know what a lot of this is. So let's just ask. Going back to options contracts, I need you to explain it sort of in the way that you just explained the margin borrowing. Just something very simple and something where it shows me examples of how the money moves around. And actually, yeah, I think that's it. An option is a contract between two people. It gives one person a right and the other person an obligation. It's not ownership of the stock, it's an agreement about a stock's price at a future date. Okay. There are two basic types. Call option is right to buy at a set price, and you're betting that the stock will go up. Put option, is a right to sell at a set price, and you're hoping that the stock will go down. The call option, let's see this example. The buy contract. Apple is trading at $100. You buy one call option with a strike price of $100. You pay a premium of $5 per share, and each option covers 100 shares, so you pay $500 total. Who's involved? You, the buyer, pay $500. The seller, called the writer, receives $500 and takes on the obligation. Okay, so it's like a direct transaction. What happens over time? If Apple's price rises to 120 before the option expires, you have the right to buy 100 shares at $100, even though they're worth $120. You can do one of two things. Pay 100 times 100 shares equals $10,000 to buy the shares. They're worth $12,000 in the market. You gain $2,000. Subtract the $500 you pay, and the net profit is $1,500. You can also sell the option itself. Its market value is now roughly $20 because it's $20 in the money. Sell it for $2,000, get your $1,500 profit the same way. Okay, so you can either get the money, your profit, and the shares, or you can just pocket the profit and give the shares to someone else, essentially. And this way, I guess you don't need to have this $10,000 to buy the shares. You're just going off this $1,500 profit, which is interesting. Okay. Money flow, buy option, you to the seller, $500, which is the premium. Stock goes up. Questions. was my question? I had a question. Oh yeah. How is the premium determined? Does it depend on the stock, or what are the factors that determine the premium you pay? Yeah, I mean, like, this is important because whenever you read examples like this and it gives you some arbitrary numbers, like, it's not how it's going to work in real life. Um, and so it's just good to know how things like this are determined. And so, yeah, that's my first question. Let's continue. You wouldn't exercise because okay, if Apple stays below $100, you wouldn't exercise because buying at $100 when the market is 95 makes no sense. Your contract expires worthless. You lose your $500 premium, and that's the end of it. Okay, simple enough. Actually, my other question then is how long of a contract can you have? Can the contract's life be as long as decades, or are they pretty much always kind of short term? Okay, I have a few kind of points in this question that I also want to touch on, but I'm assuming that when ChatGPT answers, it'll kind of touch on those. So let's just leave it at that. The put option, the sell contract. So you stock Apple at $100. You buy one put option, which is 100 shares, with a strike price of $100. You pay a premium of $5 per share, saving $500. This time the contract gives you the right to sell 100 shares at $100, even if they fall. Okay. So what happens over time? If Apple drops to $80, you can sell at $100, even though the market is $80. That's a $20 gain per share, so $2,000. Subtract the $500 premium, and you get $1,500 profit. You wouldn't use the right to sell at $100 if it's trading at 110. Yeah, because you would rather sell at a higher price. The option expires worthless. You lose your $500 premium. If you're the seller of an option, your money flow is the mirror image. Call writer, $500 premium. If the stock goes above the strike, that's when you lose money. Put writer, $500 premium. When you lose money is when the stock price goes below the strike. The seller collects the premium now, hoping the option expires worthless later. Okay, so I guess in any given contract, you have the buyer and the seller of that contract. And that's why they mention the seller side here. So for a seller, okay, so I wonder how you become a seller. If that's different from just buying a put option or a call option, then I wonder if a seller is sort of like I'm wondering, so with shorting, like the shorter is the borrower, the lender is whoever has the stocks and they're lending to the shorter. In that example, the lender they're not like going in the Robin Hood and saying like, I want to lend out 100 shares to this person. They basically just, typically I believe a lender would go to their bank or like a broker, and they would enter into a lending program where the bank would then, like, you would determine all the uh, what's the word? There's a word. I can't think of the word, but you would kind of determine like how many shares you want to lend, how there's a word. Okay, I can't think of the word. But continuing, the lender in like a short sort of process, they're not like going into Robinhood and just like manually going in and being like, I want to lend this amount of shares to this guy, lend this amount of shares to this guy. Like you just decide that you want to lend, and then like a broker will handle everything for you. For this options contract thing, I'm wondering what the seller's doing. Like I understand that the buyer would go into something like Robinhood and be like, I want to buy 10 options contracts for Apple. Like I want to buy 10 calls on Apple. Like you actively do that. But then is the seller, like, are they going into their brokerage platform and being like, oh, there's these people buying calls for this stock that I have. Like I'm gonna accept this offer and this offer, or is it sort of more like the short and lending process where you just kind of enter into a, I don't know, a seller program, an option seller program, and when people come to buy options contracts, like puts or calls, they'll just automatically get those from you. And my next question is, how does the seller side work in options contracts? Again, like, this is another example of a question where I don't feel very good about the way it's worded, but I just need to like start somewhere, and then hopefully I can narrow things down as I continue. But before I ask this, let's just continue to read through this in case I get my answer through here. I'm also asking this because I'm wondering if what a seller can lose in this situation. I kind of have an idea, but I just need it in front of my face. So I don't. What does this mean? ChatGPT does this weird thing where it's just like, whenever you're asking questions like this, it's just like, oh, good for you. What a great question to ask. What does this mean though? How is the premium determined? The price you pay for the options is set by the market, but it's based on a few predictable ingredients. Thinks of it like insurance pricing: the more likely the event or the bigger the possible payout, the more you pay, which makes sense. Three big factors that drive option premiums: stock price versus strike price. If the option is already in the money, profitable right now, it costs more. Okay, this makes me feel like it's saying that the premium can change, but I could have sworn earlier it said that the premium is paid like upfront, and so let's just see. Time until expiration. More time equals more chance for the stock to move. Longer duration equals higher premium. Okay, so that's why you wouldn't put an options contract for like 100 years into the future. Like you're not gonna, you're likely not gonna. I mean, 100 years is too much. Like 10 years in the future, like you're probably gonna pay a crazy premium. Time until expiration. Yeah, okay. Volatility, how much a stock price tends to swing. More volatility equals higher premium because there's more chance of a big move. Makes sense. So stock price versus strike price. Time until expiration and volatility. Okay, and then there's these secondary influences too. Okay, Apple at $100, a 1-month call with a $100 strike might cost $2. A 1-year call with the same strike might cost $10. Tesla, more volatile at $100, might have a $100 strike call for $15 because it moves more. The premium reflects the stock's price, time, and volatility, basically how likely and how soon it is that the option could end up profitable. Okay, so essentially, the more profitable your option could be, the higher the premium. How long can options contract last? The more options you'll see, most options you'll see trade on a normal brokerage platform are short-term, days to months, sometimes up to 2 years. Typical listed contracts called standard options expire the third Friday of each month. Oh, okay. Some stocks and ETFs also have weekly options. The longest standardized ones are called leaps. Oh, leaps. I heard this a few weeks back at a finance boot camp I attended, and this triggered my my desire to do this video. Like, someone I met there said that they bought leaps on a certain company, I can't remember, and I was like, oh, but in my head I was like, what the fuck does that mean? So if you're watching this, Mark, I'm about to know what you meant. The longest standardized ones are called leaps, long-term equity anticipation securities. These can last up to 2 to 3 years. Ooh, okay. Damn, okay. 2 to 3 years. Decades-long contracts, not really. Options that are that long are usually custom private contracts between institutions, not traded on exchanges. Retail investors can only see listed ones with short or medium durations. Okay, so this seems to be saying, actually, so this is starting to answer my last question here. How does the seller side work? I think it's about to go into that here too. How does the seller side work? When you sell an option, often called writing an option, you're not manually answering someone's ad. It's all automated through the exchange. Here's what actually happens. You place an order on your broker's platform, sell 1 call on Apple, strike 100, expires next month at $3 premium. That order goes to the options exchange. The system automatically matches you with a buyer who wants that contract at that price. Once matched, the contract is created and recorded electronically. The buyer pays you $300 premium up front. You now have an obligation, not a right. Okay, so this leads me to another question. Just to clarify, for question 3, how does the seller side work? options contracts are listed first by sellers, and then buyers come look at the available options and then decide if they want to buy or not. Or sometimes, or is it also possible for buyers to list contracts that sellers can then look through and decide if they want to enter the contract? And while that answers that, I'll just look through here. What sellers can lose? I didn't realize that there was margin or collateral involved here. Let's see what they mean. Type of option sold is, so if you sell a call, you must sell 100 shares at that strike price. If the stock goes way up, your losses are theoretically unlimited because the stock can rise infinitely. If you sell a put, you must buy 100 shares at the strike price. If the stock goes to 0, you'd lose strike times 100 minus the premium. What is that saying? So in this case, if it's $100, then you lose $10,000 minus the premium because you got paid the premium. Selling a call is risky if you don't own the shares, which is called a naked call. Selling a covered call if you already own the stock is far safer. You're just agreeing to sell your shares at a chosen price in exchange for the premium. Selling a put can be safe if you're happy to buy the stock anyway. That's called a cash secured put. I have no idea what really any of these are saying. So I guess we'll go back to that at some point. Example, selling a covered call, which is this thing. Selling a covered call, you already own the stock, is far safer. So I guess this is the generally safest option is a covered call. You own 100 shares of Apple at $100. You sell a 1-month call with a strike of $110 for $3 premium. So you get $300 instantly. Okay, so the premium is instant. If Apple stays under $110, the option expires and you keep your shares and the $300. If Apple goes above $110, you're called away. You sell your shares for, I hate all this terminology, like called away, in the money. I can't think of any more right now, but there's so many more. Like why do they have to have all this random language for it? I hope I don't come off very whiny. I'm not a very whiny person, but maybe I am with learning this stuff. You sell your shares for $110 each, $11,000. You originally paid $10,000. You made $1,000 plus a $300 premium. I lost my train of thought. You own 100 shares of Apple at $100. You sell a 1-month call with a strike of $110 for $3 premium. You get $300 immediately. If Apple stays under $110, the option expires. You keep your shares and the $300. If Apple goes above $110, you're called away. You sell your shares for $110 each. So $11,000. You originally paid $10,000, and so you make $1,000 plus a $300 premium. $1,300 total, and I guess that whoever put in the call option gets your shares, you lose that $10,000 because that was your obligation, and you keep the remaining amount, which is $1,000 plus a $300 premium. Your upside is capped, but you get steady income from those premiums. Okay. What sets the premium? On an options exchange, either the buyer or the seller can initiate a new contract. It doesn't have to be the seller first. The exchange is like a giant matchmaking system. I'm not here right now. Here's the simple answer first. On an options exchange, either the buyer or the seller can initiate a new contract. It doesn't have to be the seller first. The exchange is like a giant matchmaking system, like a stock exchange, order book, where orders are what exists first, not the contracts themselves. Let's break it down clearly. The key idea: options contracts don't exist until there's a match before you or anyone else trades them. An option is just a template. E.g., Apple $110 call expires January 17th, 2026. That strike plus expiration combination is a standardized slot, like a parking space. Anyone can place an order, either buy or sell, inside that slot. Once two opposite orders meet at the same price, the contract is created. So there's two options, two ways an option trade can start. A seller first posts, I'll sell 10 contracts of Apple, $110 call of Apple, $110 calls for $3. Buyers can see that listing and accept it. For the buyer first option, a buyer posts, I'll buy 10 contracts of Apple, $110 calls for $280. Sellers see that bid and accept it. Both are totally normal. They coexist on the order book, called the bid-ask system. Okay. How it actually looks in your broker app. When you open an options chain, the list of strikes and expirations, you'll see the buyer pays the premium up front. The seller receives the premium immediately. A new options contract is now open between both parties. It's recorded by the exchange and your clearing firm. How the clearinghouse fits in: you never deal directly with the order trader. The OCC stands in the middle. It guarantees that the seller will fulfill their obligation if exercised. It guarantees that the buyer will pay when they exercise. It handles all assignment, settlement, and collateral automatically. So yes, you can list an option as a seller, you can bid as a buyer, but all of it is automated. You never manually browse individual people's listings. Oh, what? I thought that's what it was saying here. I'm gonna take a look. I'm gonna take a look at my brokerage app and see what this looks like. And I don't have access to this. Oh no, I'm filling out a options application right now because I forgot about this, but I think typically when you make a brokerage account, it asks you your investing history, like your skill level, and what kind of things you have experience with, like just like equities or bonds or options and yada yada yada. And at the time, I didn't select options because I had no interest in it, but now that I'm trying to learn what they are, I want to look at what it actually looks like when you're going to trade. So for now, ooh, actually, I like this. I don't know how I would like that next. And then I also have questions on what exactly a naked call is. Yeah, naked calls, where does it first mention it? Naked options, cash secured put. I wanna touch more into this, but for now, we will first go down to here. Okay. I don't know how to read this right now, so let's read this to know how to read this. So, example one: buyer buyer wants a call. You want to buy $100 call. You ask $5.10, the lowest price someone is willing to sell at. I guess that's this. Oh, okay. So there's all these options, and there's this many of them. So if I wanted this, or I guess in this example, this option, at most I can buy 1,250 options contracts. And so I guess if I were a buyer or a seller, I would come in here and then see what's available, and I'd be like, oh, I like this option, and I would select this, and then I assume since these are already like things that are put up on the what was it called, OCC, clearinghouse, that once you select this and enter it, the contract immediately starts. Let's just read through this. The ask is $5.10, the lowest price someone is willing to sell at. Is that what that says here? Oh, okay. So if you want to buy $100, which this is where you come and see that value. The bid is $5. The ask is $5.10. If you place a market order, you'll buy at $5.10. The seller's ask. If you place a limit order at $5.05, your order sits in the book, waiting for a seller to accept that price. Okay. Oh, so you can do market and limit orders here too. Once matched, you pay $5.05 times 100, so $505 premium. Seller receives that $505 instantly. A new contract is created. Seller wants to write a call. You already own Apple shares and decide to sell a covered call at strike $110. You post an order, sell to option one call at $1.30. Is that something that's here in these examples? Okay, I see. Okay. What's interesting is that I feel like I've heard many people say they've bought calls or puts, but I've never heard people say they sell calls or puts. So I'm wondering if that's just something that institutions do, like they're the ones that typically list the sell option, the sell side, or if there are individuals who, I mean, there must be individuals who sell. I'd assume. That's a question I should ask. Is the seller side typically retail investors, or is it typically institutions? Yeah, like this bit and all these prompts, like obviously I'm thinking like someone who's trying to understand what this is. Like, what? I'm trying to ask questions. This is just like a waste of energy. Let's go through this clearly and simply because the seller side of options looks open to everyone, but in practice, who's on that side depends on which kind of options and what kind of strategy we're talking about. Short answer, most option selling, especially the consistent large volume kind, is done by institutions and professional market makers, but retail investors also sell options, just usually in smaller, covered, or lower risk forms. Who the major sellers are: market makers and institutions, which are the big players. These are specialized firms like Citadel, I don't know how to pronounce this one, I'm just not going to. Jane Street, Optiver, etc. They continuously quote both bids and asks for every option contract, providing liquidity. They sell options constantly but hedge their exposure using the underlying stock, futures, or other options. Their business model is to earn the bid-ask spread and collect small, consistent profits, not to speculate. They use complex risk models and automated trading systems that make up the majority of option sellers at any given moment. Makes sense. Retail sellers exist. You can do it on any brokerage platform, but they're typically selling covered calls, which makes me question if institutions are typically doing not covered calls. Are they doing naked? Whatever it was, naked something options. Selling cash secured puts, holding the cash to buy the shares if assigned. These are lower risk income generating strategies that individual investors use. Retail traders can sell naked calls or puts, but the broker often require a high account balance, special margin permissions, and experience due to unlimited or very large risks. So the retail portion of total selling volume is small compared to institutions, but it's meaningful and covered in income strategies. I mean, this all makes sense. This is just what institutions do. What it looks like in practice: when you open your broker's options chain and see a call for, say, $510 or $510, seller quoting that ask is almost always a market maker algorithm providing liquidity. If you decide to sell a covered call at $5, you can still post your own order, but the counterparty that fills it is very likely one of those institutional firms on the other side. Okay. Oh, interesting. So yes, you can be a seller, but most trades you enter are matched against a professional market-making firm, not another random retail trader. Okay. So typically in options contracts, retail investors are usually on the buy side. Would you be able to provide a percentage of what percentage of buyers and sellers of options contracts are retail investors? And if so, can you provide a source? Yeah, I was gonna say, it's not saying number of buyers versus sellers. Okay, the majority are buy orders. I wonder how much of a majority. Retail platforms, kind of size. This is talking about something that I don't want to know about. Let's see. Oh, this looks bad out of context. Buy. Oh, okay. Maybe I should take a look at this. No, this isn't. Where's 17A? What is this? This is 16A. 17A is this one. Call, put, call. Where's the? Okay, so buy side, sell side. Oh, okay, calls and puts. I'm not good at reading these graphs. They're like hieroglyphs to me. What is it, 60%? Makes up 40. I'm just making sure that these numbers add up to 100, because that'll make this graph make more sense to me. This is 38%, this is 50, 62, okay, so it seems like these all add up to 100%. And yeah, so I guess actually, I don't think this is telling me what I want to know. Buy orders dominate among retail investors opening positions of simple orders and non-SPX options that combine long positions of a call and put options. So, okay, so regardless of if you're doing calls or puts, retail only at any given time, like a quarter or less of investors are actually on the sell side, and most of the time they're on the buy side, which seems to be in line with what I've noticed when people talk about this stuff. Retail path. What is this? Oh my gosh, what is all this stuff? Call butterfly, call calendar spread, put diagonal spread. Okay. I'm gonna assume I don't really need to know about this stuff right now. So okay. Let's see what else is there. 175 non-index options on Chicago board. What percentage of the buy side of options contracts are retail investors versus institutional firms? And what percentage on the sell side is retail investors versus institutional firms? I think this will kind of answer my question better. Oh, is this the same thing? I think it is. No, it is. Google. Grok. Perplexity. What you guys got to say? Oh, it just flat out gives me percentages. It seems like I'm not gonna. Yeah, it seems like I'm not gonna be able to get exact numbers because this information is private, or a lot of this information can be private. Let's see what they say though. Well, retail share typically ranges from 38 to 45% of the total options contract value in some research. Okay, so this is kind of what I wanted to know. Okay, let's leave this blank for now. I'm gonna move on. I went down this rabbit hole because I just realized I never really heard someone saying that they've been on like a sell side of these contracts, so I was just curious. What did I want to touch on? I wanted to touch on these. Okay, I got covered call. What are these? I mean, this just sounds like a put, but why is it called cash secured put? What are the advantages and what are the disadvantages? Excellent. This is one of the best questions you can ask once you start understanding how options actually get used. Cash secured put, the safe income plus buy the dip strategy. What it is, you sell a put option on a stock you wouldn't mind owning, and you keep enough cash in your account to buy it if you're assigned. Apple at $100, you sell one put option with a strike of $90. Expiration in a month. Premium is $3 per share, so you immediately pay. Oh no, so you immediately get $300 cash into your account. You now have $9,000 in cash set aside in case you have to buy 100 shares at $90. The cash premium you keep no matter what happens. So what can happen? Apple stays above $90. So 95 or 100, option expires worthless. No one forces you to buy, and you keep the $300 as pure profit. Apple falls below $90, so it goes down to 85. You're assigned. You must buy 100 shares at $90. You spend 9,000, but you effectively bought it for 87 because of the $3 premium. Earn steady income from premiums on stocks they like. Buy the stock cheaper if it falls to their target price. Lower risk because they already have the cash ready to buy. Downsides, limited upside. If the stock stays flat or rises, you only keep the small premium. Downside risk, if the stock crashes, you still have to buy it at the strike. Could be higher than the market. Okay, I see. So I guess, yeah, this is your main risk, but the potential payoff is that you just get steady income from stocks that you already want. Someone pays you a premium to protect themselves from a price drop, and you promise to cover it, buy their shares if the stock falls. You're fine with it because you wanted the stock anyway. How is this different from just a normal put option? Is it just the fact that, is it just being more specific? Like, I mean, I guess so. I mean, it must be. Because this just sounds like a normal put option for me, but I know, like, with a put option, you can decide to actually exercise your contract, or you can sell it to someone else and just keep the premium. Or actually, was that right? You keep the premium in the remainder? Let's just continue first. Naked options, the high risk version. Naked means you sell an option without owning the stock, or without having the cash ready. It's like promising insurance coverage on a house you don't own. You're taking full risk if something bad happens. A naked call. You sell a call option without owning the stock. So, okay. Stock Tesla at $200. You sell at $210 call for $5 premium. You get $500 cash now. If Tesla stays below 210, great. You keep 500. If Tesla jumps to 300, you have to deliver 100 shares at $210. So you have to buy that. So, but since you don't own them, you must buy them in the open market at $300. You lose 9,000, 90,000 minus the $500 premium. Unlimited loss potential because the stock could go to 500 or 1,000, etc. Okay, let me just make sure that makes sense to me. Like, this all makes sense. And then this part adds a little bit of confusion. I get where they're getting $90 from. You're subtracting the current market price with the strike price that you set. So you have to deliver 100 shares at $210, but you have to buy them at 300 in this case. So you're buying $30,000 worth of stock, of Tesla stock, and you're having to deliver 100 of them at 210. That's $21,000, and so you keep the remaining 9,000. Oh, you lose. How does this work? Since you don't own them, you must buy them in the open market at $300. You lose 9,000 minus the premium, so you lose $8,500. My brain just isn't working right now. Why would you not lose $30,000 minus the $500 premium if you don't own any of the shares in the first place? Because you have to spend $30K, and then you lose 9,000, which implies that you're gaining 21,000? Is that right? What's going on? What is going on? This is generally the point where I'm just like, like screw this. Like let's just go eat. Let's go do something else. But instead of doing that, I have a meeting in 10 minutes. So I'm going to use that as an excuse to take a break. And I'll come back to this later. We're just going to continue for now. I believe I was on naked puts, which is buying or selling a put without enough cash to buy the stock, which seems straightforward enough. You sell a $9 put on Apple, collect $3, $300 in premium. Apple crashes to 50. You're forced to buy 100 shares at $90. So $9,000 total. But you only had $2,000 in your account. The broker sells your stuff or issues a margin call. You owe the difference. You can lose more money than you had. Okay, that makes sense. So if you want, even without putting up the cash you would need to normally make money off a put like this, you can still make the money, but you're putting yourself at risk of losing more money than you even own. So I guess that's what a naked put is. Oh, I mean, it goes over them right here. Why do people do naked options? To collect steady premiums when they believe a stock won't move much. Market makers and pros do it constantly. They hedge the risk elsewhere. Some retail traders use it for short-term bets, which is very risky. Yeah, that makes sense. Unlimited losses on naked calls. Huge losses on naked puts. If stock tanks, requires margin, meaning borrowed leverage, which means losses get amplified. Most brokers limit or block this for normal investors unless you qualify for advanced permissions. That makes sense. And that's honestly, that's nice of them. The summary table. Actually, let me just go back to my last question just to make sure I'm on the same page. Okay, I was just digging further into these different options for option trading. Okay, now I have a question of where did the margin come in on this? Where did that come in? Let me ask that. In the naked put example, where along the line does this margin process happen? When are you entering into a, I don't know what to call it, margin? At what point along the way are you, oh my god, I can't think. I need to cancel this. I'll write it down. I can't word it out right now. In the naked put option, at what step along the way are you? Okay. Recap. What a naked put is: you're selling a put option. I'm sorry. You're selling a put option on a stock without holding enough cash to buy the stock if assigned. Got it. You're saying, I promise to buy 100 shares at the strike price if the buyer wants to sell, and I'll collect the premium now for taking that risk. The broker sees that as a loan-like obligation. Makes sense. You might need to come up with a lot of money if the stock falls. Yep. So they treat it like a margin trade right from the start. Okay. Right from the start. Okay. How margin gets involved. Starting point. You have Apple at $100. You sell one put option strike, $90, 1 month expiration. Premium is $3 per share. You collect $300 immediately. You do not have $9,000 in cash in your account, which is the amount of money you'll need in the event that Apple falls down to the strike price of $90. So you don't have that money. You do have margin approval. You sell the put. The broker sets aside margin collateral. When you sell that put, your broker instantly credits you $300 in premium, but also locks up margin collateral, a safety buffer to make sure you can afford to buy if needed. The required margin varies by broker and regulation, but roughly it's around 20 to 25% of the stock's value, more if volatile. So for a $9,000 obligation, the broker might require $2,000 to $2,500, or $2,000 to $2,500 in margin equity as collateral. That can come from your existing cash or other holdings in your account. Okay, so you can't do it with absolutely $0, which makes sense. You now effectively have a loanable cushion. The broker is trusting you for the rest. Okay. How trustworthy. Stock price moves, margin usage adjusts. If Apple stays above $90, the option loses value over time. I lost focus. If Apple stays above $90, the option loses value over time. The broker gradually increases some margin. Risk is declining. You keep your $300 premium when it expires worthless. No loan ever triggered. No interest owed. In this example, if Apple stays above $90, the option loses value over time because you're not in the money, as they say, I guess. Broker gradually releases some margin. I don't know what that means. Releases some margin. You keep your $300 premium when it expires worthless. No loan ever triggered, no interest owed. If Apple starts falling, let's say Apple drops to $85, your put is now in the money. Someone could force you to buy at $90. The options market value might jump to $600. Your unrealized loss, 600 minus 300 is negative $300. Broker increases your margin requirement because risk just grew. Now maybe you need $3,000 of margin equity instead of $2,000. If you don't have that much available, the broker issues a margin call. I zoned out in the middle of reading that. I think my brain's a little done today, or at least right now. Let's just force our way through it for a second. If Apple starts falling, so okay, the general message I'm getting is that for naked puts, feels weird to say it in that context, naked puts and naked calls, I think I said it earlier, but it is, yeah, you're betting that the stock won't really do much because you're just trying to collect the premium, I believe. And so when you're doing normal puts and calls, I need to turn my phone around, I keep looking at it. When you're doing normal puts and calls, you're hoping for the value of the stock to go down or up, respectively. And when you're doing naked puts and calls, you're hoping that the stock value doesn't move much because you don't want to be, what's the word? I can't snap right now. You don't want to be, they used the word somewhere earlier. I will find it. Oh, you don't want to exercise the contract, or however you word it. You don't want to exercise because then you need to buy or sell a bunch of stocks that you can't afford. So yeah, for naked puts and calls, you're just trying to collect premium. At the risk of possibly losing more money than you even own. let's say Apple drops to $85, your put is now in the money. Someone could force you to buy at $90. Your options market value might jump to $6 when you're forced to buy. If Apple closes below $90 at expiration, the put buyer will almost certainly exercise their right to sell. Right, okay, that's fine, okay. I was just thinking, what's stopping the naked put seller to, like, I was thinking of ways that a naked put seller would get out of this, and my initial thought was, like, why don't they just sell the contract to another person, because I saw above on the normal puts and calls that you can do that, but that was immediately answered by me realizing that no one would want to buy a contract like that. And then I was wondering if there was any other way for them to get out of this situation if the worst case happens. And I realized it's not really up to them. The buyer is the one that would exercise their right to sell. And yeah, the buyer would almost certainly exercise their right to sell. And you're now assigned, so you must buy 100 shares at $90 or $9,000. But remember, you only had $2,000 to $3,000 of equity, so the broker automatically lends you the rest. Broker margin loan is $7,000. Now you own 100 shares, but you're on margin for $7,000. That's where margin borrow actually happens, at assignment. After assignment, you own stock on margin. You now have 100 shares of Apple worth maybe $85 each, so $8,500 in market value. A $7,000 margin loan. Your equity is $8,500. Your margin loan is $7,000. That subtracted by that is $1,500. You still keep $300 premium. Your net equity is $1,500 plus the $300, so $1,800. You now owe interest on that $7,000 margin loan, whatever your broker's annual rate is, say 9% yearly, charged daily. If Apple falls further, your equity shrinks, which could trigger another margin call. This is scary. If Apple rises, great, you can sell shares and repay the margin loan, keeping the profit. Oh, okay. Interesting. This is a rough situation. That would be very stressful. I don't think I'll ever want to do naked puts. But maybe that'll change if I actually know things in the future. So what's really happening? Sell a naked put. Broker sets aside margin requirement, preload insurance. Margin requirement increases, protects broker. Okay, margin borrowing doesn't happen immediately. It only kicks in if you're assigned and you must buy the stock. Until then, the broker just reserves margin collateral as a safety buffer. Okay. Okay. Is that everything? I think I wanted to go into, okay, what's the difference between a cash secured put and a normal, like a covered call put, I believe it was called, like a normal put? Oh, okay. So a covered call is just you have the stock, and the cash secured put is you don't have the stock, but you have the cash ready to buy the stock. Okay. Okay. Now it's just a matter of if I remember this in like a month. Is that everything? Hold on. Alternative ownership structures. I mean, this doesn't really apply to me right now. Stocks given as a part of compensation. This can, but I already kind of know what this is. This is literally like, if you're holding any stocks that, actually maybe I shouldn't speak so matter-of-factly. I think what this is if you're holding any stocks that pay dividends, then you can, on your brokerage app or website or whatever you're using on the platform, you can set it up so that whenever you get dividends paid to you, you can have those dividends automatically buy more shares or buy shares in a stock. There's a lot of people who just want to have things invested and then just leave it alone. And so this is really nice for that, because if you don't do this, then every month, every quarter, whenever dividends get paid, you'd have to go into your account and buy more shares, like buy more stock. And some people don't want to do that. Some people just want their account to just keep buying the stock because they know that they're doing some long-term investing strategy, and these drips are what that's for. I feel like I should make sure though, but I really don't want to right now. But I have to go a little further into drips. Oh shoot. Nuts. No, not strips. It's crazy that I did a typo for some acronym. Is it acronym or abbreviation? I basically typed in a random word and there's some financial thing for it. Which honestly annoys me. there's so much jargon in this. It's like, why? Does it really need to be this way? I mean, yeah, it does. I would hate to work in finance and have to say separate trading of registered interest and principal of securities every time I was talking about this thing, and calling it strips is probably a lot nicer. Anyways, that's not what I meant. Let's go into drips. I hate these. I don't know why they bother me so much. So like unnecessarily polite. I don't know. Maybe I'm just hungry. Where strips are, what a drip is: dividend reinvestment. It's a program that automatically takes the cash dividends you earn from a stock and uses them to buy more shares of the same company instead of paying you. Okay, so this is kind of where I was kind of feeling a little bit like unsure. I didn't know if you could use drips to buy shares in a different company, or if it had to be in the same company. Yeah, so I'm going to just clarify just that, and if so, I think we're done. So, can you use drips to buy shares in another company? Yeah. Oh, okay. So there's the reason for that is there's a drip system thing where it's designed to reinvest in one security, and so okay. What are the workarounds? Even though you can't tell, you can choose turn off drip, redirect dividends yourself, let your dividends come in as cash once a month or quarter, use that cash to buy any. This isn't this is just manually going in and reinvesting your dividends. Oh, but still easy to automate. Okay. I just got to read one more line. It answers my questions. Have I had bad posture this whole video? No, I'm not gonna sit like this for hours at a time. I'm gonna sit like this. Works like a drip, but you're defining where the money goes. All dividends, interest going into this. I mean, okay, so you can technically do what I was talking about, or what I was wondering. It's just not. Oh, you can. Okay, I didn't realize you could set up things like this. Okay, so you can. It's just not a true. Yeah, it's not a true drip. It just functions the same way. So I mean, it still technically is a drip. It's just not. It's not true drip. Okay. Okay. I think I'm good. I think I think I have I think I understand all these now. And obviously I don't know all the different strategies you can do with like options, contracts, and all the things you can do to like hedge against different things you're doing and whatnot and this and that and whatever. But at least I know what these things are now. Um, as for the complexities of it, I can get into that in the future. I just wanted to know what people are talking about when they say they're buying calls and like what that implies. So yeah, I think that's it. So this video was pretty rough, but I learned a lot, and I don't just mean on the topic I chose. I mean in terms of editing and formatting and filming and recording. Again, lesson learned on breaking down future topics into more bite-sized bits. I don't think I can sustain recording then editing hours of footage while also uploading on a regular basis. Also, I should have kept fact checking on different chatbots, but frankly, I just got lazy. Honestly, my whole being just wanted to pull away from this as I was doing it, so it was hard to delve deeper into certain points, and especially towards the end. Um, I would just like to justify my actions by saying that I feel like these topics didn't require much speculation, and so I figured there wasn't a lot of room for ChatGPT to misinform me, but that's probably not true. There were several examples that just felt like they were worded really poorly. And it's not good practice. So I will try to change that going forward. Another thing I realized while filming is that I have trouble talking about these concepts out loud because I just don't know the right words to connect dots. I noticed I kept getting tangled in my thoughts as I was trying to explain certain concepts. I don't know if that's because I practically never have to explain these things out loud, but I kept trying to explain things and then provide reasoning and examples and pros and cons, and sometimes I just wouldn't know for sure, but I would just start assuming, and I would catch myself assuming, and then I would just be like, wait, what am I doing? Stop it. And going off of that, I'm noticing there were a lot of times when I would understand a concept in my head, then when I try to explain it out loud, I think because I just didn't know the language for explaining it, I would start to confuse myself. But conceptually, just in my head, it makes sense. So I'm not sure if that means I understand it and I just can't explain it out loud, or if that means I actually don't get it. I guess I'll see in the future. And that's everything, I think. Um, this was not how I expected this video to go. And I would have loved to shorten it down into an actual like digestible piece, but it was either keep a lot of it or keep like none of it. And just for the sake of record keeping, I wanted more of it around than not, and so this is what this video became. But yeah, in the future, I will be cutting these down into things that people might actually spend time watching. So, with all that said, I think there's nothing more to say. So, I am Jason Kim, the clueless investor, and I'll see you next time.